Datavault AI Inc., trading under the ticker DVLT on the Nasdaq, is currently priced at 93 cents, showing a decline of 8.13% in today's session. While a drop of over 8% might normally signal a quiet exit for most retail traders, the reality under the surface of this particular move is far more complex than a simple sell-off. The immediate insight you need to grasp here is the staggering disconnect between the company's internal financial projections and its current market valuation. Just a few weeks ago, management raised their 2026 revenue guidance to exceed $200 million. For a company with a market cap currently sitting in the small cap territory, that kind of top-line growth would typically command a massive premium. Yet here we are, watching the stock struggle to maintain its footing above the dollar mark. This gap creates a massive curiosity loop. Either the market is completely missing a massive growth story, or there's a level of skepticism regarding the execution of these lofty goals that is keeping the big players on the sidelines. The general expectation for any stock with AI in its name during this period of the market has been a relentless climb, similar to what we have seen with Nvidia stock, or even the speculative runs on various penny stocks that promise to change how we handle data. Investors often flock to these names looking for the next big hit, hoping to catch a wave that mirrors the stability of Apple stock or the volatility-fueled gains of Tesla stock. The narrative for Datavault AI was supposed to be one of rapid expansion through its patented data tokenization and acoustic science technologies. However, the reality we are seeing in the price action today reflects a growing tension. The market is reacting to the recent postponement of a warrant distribution, which was moved from early January to late February. When a company delays a benefit to shareholders, especially one tied to a requirement of holding a specific digital collectible like the Dream Bowl meme coin, it creates a friction point. It makes investors wonder if the underlying plumbing of these digital asset distributions is truly ready for prime time. If you look at the intraday movement, the volume is telling a story of intense debate. We are seeing millions of shares change hands as the stock tests its support levels. On platforms like the Robinhood app or through an interactive broker's account, retail sentiment seems divided between those who see this as a classic buy-the-dip opportunity and those who are concerned about the recent insider selling. When you look at the activity on a Fidelity trading platform or within a Schwab Intelligent Portfolios allocation, you notice that institutional footprints are still relatively light, which adds to the volatility. This isn't a stock that is being quietly accumulated by pension funds just yet. It's a battleground for active traders. This volatility is a far cry from the steady growth one might find in Fidelity mutual funds or the diversified safety of Fidelity ETFs. Instead, DVLT represents the high-stakes side of online investing, where the distance between a total loss and a 10-bagger is razor thin. The recent momentum was actually quite positive heading into the new year. We saw a massive surge in early January after the company announced it had hired high-profile legal counsel to protect its intellectual property. This move was seen as a signal that their patents in data valuation and digital twins are valuable enough to defend aggressively. Furthermore, the master purchase order with AP Global Holdings to deploy infrastructure across 100 cities was a significant fundamental win. It suggested that their technology isn't just theoretical, it's being built into the physical world. But as we see today, even good news can be overshadowed by technical delays and the unconventional nature of their dividend strategies. The requirement for shareholders to interact with a meme coin to exercise warrants is a move that feels very Web 3.0, but it's one that might be confusing for someone used to the traditional structures of a Fidelity brokerage or a SoFi trading platform. To truly understand why the stock is behaving this way, we have to look at what Datavault AI actually does. They operate at the intersection of data science and acoustic science. Their data vault and data value agents are designed to help businesses figure out exactly what their raw data is worth and then provide a way to trade it securely. They've even collaborated with IBM to integrate these tools with Watson X, which adds a layer of enterprise-grade credibility. On the other side of the house, their acoustic science division, which grew out of WiSA Technologies, is working on high-performance wireless audio. They're trying to make it so that your TV or phone can transmit high-fidelity sound to speakers without any wires and without adding to the cost of the hardware for the manufacturer. It's a clever licensing model. If it works, they get a piece of every device sold. If it doesn't, they aren't stuck with a warehouse full of unsold speakers. This shift from selling hardware to licensing software is a classic move to improve margins, but the market is still waiting for those margins to show up in the actual earnings reports. Recent earnings showed revenue growth of over 140% year over year, which is objective proof that they are finding customers. But the net losses are still substantial. This is the expectation versus reality trap that many growth investors fall into. The expectation is that triple-digit revenue growth leads to a soaring stock price. The reality is that if you're spending more than you make to acquire that revenue, the market will eventually penalize you, especially when interest rates or macro pressures make profit-later companies less attractive. For someone doing self-investing through a SoFi active investing account or managing their own individual brokerage at Fidelity, the question is whether the current price reflects a fair value for the future licensing fees or if the company will need to raise more capital, potentially diluting current holders. Comment below how many shares of DVLT you currently hold, or if you think the meme coin requirement for the warrants is a genius move or a distraction. Looking at the broader sector, we see a lot of interest in secure data management and the intersection of AI with cybersecurity. The collaboration with luxury retailers like Reflexi to use holographic displays and spatial audio for brands like Gucci and Tom Ford shows that their technology has high-end appeal. It's about creating an immersive experience that traditional advertising can't match. If they can prove that these installations drive actual sales for these brands, they could see a massive influx of interest from other retailers. This is the kind of hidden catalyst that doesn't always show up on the front page of investing sites, but can drive long-term value. It's a different play than just buying shares of a mega cap like Nvidia stock. It's a bet on the last mile of AI, how it actually interacts with human beings in a physical store. For those using tools like Schwab Intelligent Portfolios or a SoFi Robo-Advisor, a stock like DVLT likely won't show up because it's too small and too volatile. It requires a more hands-on approach, the kind you get with interactive brokers trading or by using the Fidelity mobile app to keep an eye on real-time movements. The risks here are clear. The company is still in a heavy growth phase, and their unconventional corporate actions like the special dividend of warrants and the association with digital collectibles can be off-putting to traditional analysts. There is also the matter of the short report from Wolfpack Research and the subsequent lawsuit filed by Datavault. This kind of legal back and forth often creates a cloud of uncertainty that keeps the price depressed until a clear winner emerges in the courtroom or the financials become so good that the short thesis evaporates. The institutional ownership of DVLT is currently very low, under 1%. In the world of online investing, this is often a double-edged sword. On one hand, it means there isn't a lot of big money support to keep the price stable during a sell-off. On the other hand, if the company hits that $200 million revenue target in 2026, those institutions will be forced to take notice. If Vanguard or BlackRock start adding DVLT to their small-cap index funds, the buying pressure could be immense. But right now, we are seeing the opposite, insider selling. When the CEO and other executives sell shares, even in small amounts, it sends a signal to the market. Even if those sales are for tax purposes or personal liquidity, the timing right before a price drop always looks bad to the retail crowd watching on a Robinhood stock screen. As we move toward the February 21st date for the warrant distribution, expect the volatility to increase. This is the next major catalyst. If the distribution goes smoothly and investors see value in those warrants, we could see a rapid recovery. The warrants have an exercise price of $5, which is significantly higher than where we are now. This implies that management believes the stock can reach those levels within the next year. It's a bold statement of confidence, but as always, the market wants to see the receipts. They want to see the licensing agreements with the multinational corporations that the company has mentioned in their calls. They want to see the revenue from the AP Global deal hitting the balance sheet. In summary, Datavault AI is a textbook case of the tension between a visionary business model and the harsh realities of the public markets. The company is swinging for the fences with data tokenization, holographic retail, and wireless audio licensing. The growth numbers they are reporting are objectively impressive. However, the stock price at 93 cents reflects a show-me attitude from investors. The complexities of their warrant distribution and the requirement of holding meme coins have created a hurdle for traditional investors who might otherwise be interested in a high-growth AI play. Whether you are using Robinhood fractional shares to build a small position or managing a complex portfolio through Fidelity Wealth Management, the key here is to separate the noise of the daily 8% swings from the long-term potential of the technology. The reality has fallen short of the initial AI hype expectations for now, but if they can execute on their 2026 guidance, the current price might one day look like a footnote in a much larger story. The contrast between the ambitious $200 million forecast and the current penny stock status is the defining theme for DVLT. It's a high-risk, high-reward environment that requires a clear head and a deep understanding